Welcome to this detailed explanation of Unit Y4 from the subject Security Analysis and Portfolio Management. In this session, we will explore crucial concepts, principles, and formulae that are foundational for portfolio theory and management. Let's dive right in. A portfolio is a collection of financial assets such as stocks, bonds, and other securities. The purpose of creating a portfolio is to diversify investments, mitigate risks, and optimize returns. By strategically allocating investments across different asset classes, investors can achieve a balance between risk and reward tailored to their financial goals. Portfolio theory is based on two key principles: the risk-return trade-off and efficient allocation of assets. The risk-return trade-off emphasizes that higher potential returns often come with higher risks. Efficient allocation ensures that assets are distributed based on an individual's risk tolerance and financial objectives. The process of portfolio management involves several steps. First, setting investment objectives such as growth, income, or risk reduction. Next is asset allocation, which determines the proportion of investments across asset classes. Security selection involves choosing specific securities, and finally, monitoring and rebalancing the portfolio ensures it aligns with your goals over time. Traditional portfolio analysis evaluates each security in isolation, focusing on its performance metrics. In contrast, modern portfolio theory, introduced by Markowitz, incorporates the relationships between securities, emphasizing correlation and diversification to reduce risk and enhance returns. Diversification is the practice of reducing investment risk by spreading investments across various asset classes or securities. By combining assets with different risk profiles, investors can mitigate the impact of poor performance in any one investment. The random walk hypothesis states that stock prices follow a random path, making future price movements unpredictable. This theory supports the idea that markets are efficient, and current prices reflect all available information. Markowitz Diversification focuses on creating portfolios that lie on the efficient frontier. Using a mean variance optimization framework, it identifies combinations of assets that maximize returns for a given level of risk. The impact of combining securities depends on their correlation. Lower correlation between securities reduces overall portfolio risk, as negative movements in one security can be offset by positive movements in another. Two key portfolio metrics are portfolio return and portfolio risk. Portfolio return is calculated as the weighted average of individual security returns. Portfolio risk considers the variance and covariance of returns. Portfolio beta measures the sensitivity of a portfolio to market movements. It is calculated as the weighted average of the betas of individual securities. A beta greater than 1 indicates higher sensitivity to market movements, while a beta less than 1 indicates lower sensitivity. The Sharpe Index Model evaluates portfolio performance based on risk-adjusted returns. The Sharpe ratio is calculated as the portfolio return minus the risk-free rate divided by the portfolio standard deviation. That concludes our comprehensive overview of Unit FU, Security Analysis and Portfolio Management. Remember, understanding these concepts and applying them effectively will greatly enhance your investment decisions. Thank you for watching, and happy learning.